Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment Workshops, and we're doing our entry level into life insurance. And this week we're doing our introduction into variable universal life insurance. And of course, what I like to always say to you, remember, this is a security. You have to be FINRA licensed, minimum Series 6 and 63, before you can even talk about this, show it, or even speak bad about it in certain states. Just a little heads up. We're over on our software front page using the Eclipse software from Lincoln Benefit, which we chose as the easiest software to use in illustration system. It's excellent. Just go out to that site, www.lblsales.com/ETW. As soon as you come to the site, hit Run Installer. It'll install the software for you, and you'll be able to go page by page with us. We found time and again that going page by page with us really helps the tutorial process and it'll really make your learning curve increase. Also, from Lincoln Benefit, an Allstate company, really these guys do a really good job on inventory, on information. And I'm on their site, which is showing on the bottom, and of course if you see our search engine optimization description, we also have it in that if you want to cut and paste it in. And what we have here is several things that you can use for life insurance evaluation and so forth. But one of the things I really like is the Facts of Your Life booklet. It comes in electronic form or hard copy form, and that book will allow you to gather all your clients' data and information, and ideas and things that I never even thought about are in this book. We really like it. We highly suggest it. While you're on this page, Lincoln Benefit and Allstate have really constructed some wonderful marketing campaign materials with prospecting letters and postcards. So if you're unfamiliar in our business of life insurance and you say, boy, I'd really like to use this, you can go out to it and use it. If you're FINRA licensed, you still have to run it through your compliance department, or if you're in an insurance agency and they have compliance, you're going to have to run this through them as well. But we think they're really basic. Most of the people that we've been talking to have no problem getting it through compliance. Again, we're just suggesting that you look at this and utilize it in the best way you can, because these are really good docs and it'll get you in the game kind of overnight on how to talk to clients and market to clients about life insurance. And then this is our homepage, www.brokersalliance.com. If you miss any of our shows, and again, especially if you miss our Edutrainment Workshops, we ask you to go back to the beginning. We're about 2/3 of the way of the class at this time, and really you need to go back to day one and build the foundations and how we've constructed this in the basics so that you can really understand where we are today. So you can hop back out there. They're only 15-minute video vignettes, and you can watch all of them. If you get behind, no problem. Go out to our site, www.brokersalliance.com. Come to our homepage, hit the on-demand video button. It'll put you right into our archives, and you can get all caught up. Well, today we're going to be using Lincoln Benefit software, and hopefully you've already been online. And actually this area is called the weighted average and investment options. And what Lincoln Benefit has done here, and many of the VUL, variable universal life carriers do, is when you don't choose your own customized asset allocation model, what they do is they take every single sub-account, every separate account that they have, and they put on a very small percentage. As you can see, a lot of this is less than 1%, and they build a model, and this model of weighted average, as we said yesterday, this model costs you about 67 basis points all in if you were to use this weighted model. My ideal grid for this would be, it would show the asset allocation, how much went into that fund, how much the actual annual expense costs, and I'd love someday, this is just my fantasy, to have a third column that says beta risk. What's the risk of this fund? That would be dynamic to have something like that, because then you could weigh out, wow, the cost, the risk, how much should I allocate for that? Now remember, if you're not an asset allocator, you should not be doing customized plans. If you're not really an aficionado on the funds, you may want to default to this or get some registered investment advisor who really understands funds to go ahead and figure this out after you've done a client profile on suitability and risk. Once you've done that, and we have that to give away, if you just say, Steve, I'd like to have a client tolerance kind of a measurement, and we walk you through a kind of a questions and answers for the client, and it gets you in the game, and it measures their ability to take on risk, and is it suitable? So you can always do that, and once you find out what your client's suitability is, what their risk tolerance is, then you want to partner up with somebody if you're going to go customized. If you're showing this now at the front end just from a weighted average point of view for illustration purposes, this could be okay. Remember, a lot of people also, just before we got into indexed universal life, a lot of us, including yours truly, for years in the early to late 1900s, late 1999 and early 2000, 2001, we were all using the S&P 500. Now this one, it just happens to be the Fidelity VIP Index 500 portfolio. And I really like this because look at the number it cost me. It's one of the lowest in the funds, 20 basis points. And just a heads up, because we got people to cheat on this all the time, some of the lowest funds, of course, are money market funds, but no money market funds paying more than what? 0.15, 15 basis points. And you can't use that because it's so cheap, right? So about the best one in here, if you had to kind of argue this, you could say in a VUL contract where I have a indexed 500 portfolio, my cost is 20 basis points, but if I get a return from the S&P, I fully participate in it. There are no caps, no spreads, and no participation ceilings. I could be fully invested and I get dividends, whereas in indexing, and we'll talk about this next week, I don't participate in that. So people say, boy, if I'm a long haul player and I think the numbers are going to be good and I want to do this, I may start looking at this and saying, wow, let's look at that and say, should I be doing indexing in a VUL or indexing in an index contract? You'll have to weigh out the risks because you could lose all of it in this sub-account. And remember, you still have policy expenses to pay. Now, just a little review. I noticed that some of the actual balance here, that there's some that have hardly any in here, and then some of them are at 5%, 6%, 2.89%. And look at this asset allocation mix. See, it's very, very diverse. I mean, they're using almost every sub-account that they have inside this contract. So it's very diverse. And look at the price tag. You could go down from what I said was the index at 0.20 or 20 basis points, and look at this fund here. The Fidelity Emerging Markets, that's a 0.31. Wow, that's 131 basis point. That better have turned some serious numbers, and we'll look at this tomorrow on some of the historical rates. What has actually occurred? And if I'm going to spend $1.31 on this fund, has it really performed in such a great way that it can actually take on this kind of an expense load? Remember, one of the reasons we did indexing on VUL platforms back in the day was because it was so cheap, you could have all access to dividends, and when you're talking about the difference between doing a S&P 500 at 20 basis points and a separate sub-account that's very expensive at 131, this better be a great fund and it better have some great historical value, or I don't think you're going to get an asset allocator or a registered investment advisor who's very attuned to their own customized asset allocation to go beyond doing something a lot cheaper than that, probably half that rate. Remember, in this weighted model that we're showing you, we're actually showing you a weighted model that all in, based on this configuration, is only 67 basis points. And you say, Steve, I'd really like to see that. If you want to see this yourself, I'm happy to send you the illustration. Just write me, thebiz@brokersalliance.com, and I'll just send it to you. Now, it has another page, I think, of a few more that I wanted to look at. And again, most of these, except for with a few here, are under 100 basis points. Remember, I have the M&E charges, I have the policy expense loads, and will those loads, will those expenses be greater than the tax advantages, especially in an income scenario? I'm going to have to do the balance sheet numbers. I'm going to have to figure out which one's the best way, and that's what I'm going to do. I'm going to kind of measure that out. Now, I'm going to detract just for a second here, and I want to talk about one thing. And another expense charge, of course, is the cost of insurance. So I just looked at the fund, and I'm just going to touch on this just for a second. I'm going to look at blood pressure, cholesterol, history. I want to know what numbers, because my goal is to choose the person, especially in an income scenario, who has the best cost of insurance. And what I like about Lincoln Benefit software here is I chose Preferred Elite, and it's going to say, these are the requirements for Preferred Elite, and you'll be able to look at this, height and weight charts, your blood pressure where it needs to be laying out, your history issues, your sibling of your parents, your family tree history, your hazardous sports, all your involvement, and then it goes on even here to describe preferred non-smoker, standard non-smoker. So that's going to mean something in your expense load. So I always want to just stop by and look at this to see if what I'm actually quoting has a reasonable chance of being underwritten and my offer from a carrier like Lincoln Benefit will actually come through the way I illustrated it. Remember, most of the time, people are writing these contracts and the not taken offers, the NTO, are quite high. And companies are really looking between 70 and 75% placement ratio. When they don't see that, then they wonder what's going on. Are we mismatching? And part of that mismatch always happens in what we qualify the client as. So we definitely want to qualify the client and make sure we're doing the right numbers and make sure we're all, and I want to get back over here to my premium page. Now, I'm on the front page, premium page. You always want to make sure that everything you said, I check my work before I go in front of a client, and I want to look at my premium page, and this is the basic page. Tomorrow we're going to get into the internal rate of return pages. My annual premium page, there's no distributions yet because we're not doing an income scenario in this scenario, and net surrender value. Notice I put 3912 and I have no access to cash. Now, I actually have money per policy values in here, but I don't have access to cash because of the surrender charges. So when I'm looking at a client and that client says, I may need to get money the first 10 years, this is not the contract. This is not a liquidity issue. And if I built it as an income issue, I would have to see if I have to at least be in this for 5 years at a level death benefit, more than likely. There might be some exceptions to that, before I would even think about telling the client, you need to be in this and paying for it a good 5 to 10 years and taking income later. If liquidity is an issue, this is not the contract. Now, again, notice our 67 basis points is 10% gross we're showing, but it's 9.33 is the net effect, which is going to be credited because I have expense loads to pay. So when I look through this line, it also looks at the gross rate of return. It shows 0 credited. What will this contract do? And remember, if you opt for the guaranteed or the limited guaranteed for death benefit, it will show you the guaranteed death benefit on this at no cost and also maximum charges. And look at the net rate shown over here, 67 basis points is coming out on my allocation. If I get 0 or it goes below it, it doesn't matter. That is the charge that's going to happen that year for that specific fund or the collection as we're using the weighted average. So I just want to kind of show you some of this as we're getting ready to kind of look at this tomorrow. And now look at this here, and I really love this. This page is the 30-year fluctuation, hypothetical returns. So we went back 30 years and said, okay, for 30 years from last year, we're going to look at this number and look at 18% return. Boy, I wish. 19%, 6. Look at all these positive numbers. But then about a couple years out, that actually lost. The S&P on about the 21st year, years ago, lost 3%. Then some of these other losses, look at this, 9% loss, 12% loss, 22%. Those are 3 straight years in a row. So remember, that's a lot to absorb on a contract, and you want to make sure that you can absorb that. And then look at recently, we put in that 37% loss, which is a really bad boy year, I really realize. But I wanted to show this to see the actual numbers, to show what kind of returns I would get in this contract and mapping it to the asset allocation mix. We're trying to at least see what would it have been. Try to give the client a heads up on the patterns of returns in the market so I can show something. And again, these aren't going to have actual figures for the future because the historical past has very little to do with the future, but it kind of gets us in the game and well rounds out our thinking. We can show the client, we're trying to disclose to the client, here's the activity that's happened, and look, there are some bad boy years here, 37 years, but I also noticed that there were some good years. We had 26%, 25%. So these are all good indicators, 31%, I love that one. These are all good indicators on what history did and what kind of numbers we should be projecting on variable universal life.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.